Hi everyone, I welcome each one of you to my channel Econopatsala. Today I'll be discussing about the concept of GDP and its measurement. This comes under National Income Accounting in macroeconomics, which is covered in at PA level as well as at PG level in economics courses, macroeconomics courses in most of the universities and colleges. In one of the preceding sessions, I had already hinted about GDP. In the session of macroeconomic indicators, we had discussed about GDP as a proxy for size of the economy. Okay, so by size of the economy, what we mean? The total value of goods and services produced in an economy is represented by GDP, which is also a proxy for total amount of income generated in the production process, as well total amount of spending on goods and services produced in an economy. Okay, so in the preceding session, when I was discussing about circular flow of income using a chart, I had explained how in an economy, GDP, which is total value of goods and services produced, is equal to total amount of income generated, also is equal to total amount of spending on different goods and services produced in a country. And this is used to compare the size of different economies. So when we say the US is the largest economy, or the China is the second largest economy, India is the fourth largest economy in the world, basically we compare that GDP. Chinese US GDP is the biggest, and Chinese GDP is the second biggest, and India's GDP is fourth largest. That is total value of production of goods and services in US is the highest, China is the second highest, so on and so forth. Now, a closely related concept to GDP we had already flagged in one of the earlier sessions is per capita GDP or per capita income. Per capita GDP is used as a proxy to compare the standard of living of average citizen in a particular country. So when we divide GDP with population, we get per capita GDP, or with some adjustment, we get per capita income. So based on that, we divide countries into rich, middle income, poor, etc. So when we say Singapore is one of the richest countries of the world. So what we mean is per capita income or per capita GDP of Singapore is one of the highest. Okay, but obviously Singapore GDP will be much smaller compared to Indian GDP. So in terms of size of the economy, Singapore economy is less or lower compared to Indian economy. Okay, so that is we're comparing GDP of Singapore versus GDP of India. But when we compare the countries in terms of rich and poor, there what we use per capita GDP for the comparison, or per capita income for the comparison. Now, we have already discussed earlier that economic growth is nothing but percentage change in GDP of a country in the current year compared to the preceding year. So if economic growth is high, rapid, that suggests overall production, overall income generation in a country is growing at a faster pace compared to the past. On the other hand, if economic growth is low, this suggests that the GDP in a particular country is growing at a lower pace compared to the preceding year. So given the importance of GDP, economic growth, per capita income, etc., it will be a quite important session for you to understand about what is GDP and how it is measured. Now, today's session, I'll be dividing broadly into three sections. First, I'll be discussing about the concept of GDP, okay, how it is formally defined, and following that, I'll be spending some time on how GDP is measured, okay. So this will be taking bulk of our time today, and towards the end, I'll be discussing about the challenges in GDP computation. So starting with the concept of GDP, so basically formally GDP is defined as the sum of value of final goods and services produced during a period in a country. So the terms which are highlighted, which are written in red, is very important for you to understand clearly. First, sum of value. So as I said, GDP is a proxy for total production of different goods and services. Now, different goods and services are measured in different units. Say apple is measured in kg, maybe paddy is measured in quintal, milk is measured in liter, flight services, in number of flights. So this way, they are not comparable. They are measured in different units. So to reach at a common value of various goods and services produced, what we need to do, we need to multiply the quantity of production of a particular good during a particular period by its price. Say for example, the quintals of paddy multiplied by price of paddy per quintal will give us value of paddy produced during a particular period. Similarly, liters of milk produced during a particular period multiplied by its price will give value of milk. So then we can add the value of paddy in rupee, value of milk in rupee, value of internet services in rupee, value of flight services in rupee, and we can count GDP in a common number like so many billion rupee or so many trillion rupee. So that's how the importance of value. Now the final good, the distinction between final and intermediate good, I'll be discussing in the next slide. It is slightly complicated. Now let me move to the next one. GDP refers to a particular country like Indian GDP or GDP of USA. So the value of final goods and services produced within the geographical boundary of a particular country like within India, within US, okay, that refers to GDP of India or GDP of US respectively. So GDP refers to a particular country. Then period. Now, GDP refers to a particular period within which, during which production of different goods and services took place. Say, in general, when we talk about annual GDP, people refer to a calendar year. So goods and services produced, say from 1st of January up to 31st December of a calendar year within a country is refers to GDP of that country in that year. Say the American GDP for 2025 will include value of all final goods and services which were produced from 1st of January 2025 up to 31st December 2025. In Indian context, our GDP is measured in a financial year term. So from 1st of April of a year up to 31st March of the next year, that is our financial year. So goods and services which are produced during that period, we refer as GDP of India during that financial year. Okay. Now, one more thing important to remember, not necessarily GDP is counted only annually. GDP also is counted for different quarters. Say, for example, in India, GDP produced between 1st of April up to 30th June of a particular calendar year, of a particular year, is GDP in the first quarter of that financial year. Okay. So as I said, final goods and services I'll be covering in the next slide, that concept. And then GDP, as I said, is a proxy for aggregate income, also a proxy for total spending on goods and services produced in a country. Then GDP is also expressed on real terms and nominal terms. Why it is so, that I'll discuss little later. And for cross-country comparison, to compare GDP of India versus GDP of China versus GDP of US, we have to convert into a common currency like US dollar. That is what also I'll be discussing in the following. So first, let me elaborate on what is the distinction between final good or intermediary good. A good is distinguished as final or intermediate good depending on its use. If a particular good is used for direct consumption of a household, then we call it is final use of the good or it is as a final good or service. Similarly, if a good is not used for direct consumption, rather it is used as an input to produce another good or service, then that good or service is referred as intermediary good or intermediate use of that particular good and service. So I'll explain this with two simple examples. Let us talk about wheat flour. So wheat flour, when it is used by a household to make chapati for domestic consumption, then wheat flour is an intermediary good. So it is basically this is an intermediary use of this good wheat flour. Now the same wheat flour, when purchased by a baker to make bread, then that is intermediary use of wheat flour. So in that case, it is an intermediary good, or it is used for intermediary consumption. Sorry, intermediary use for producing another good. Similarly, we can think of apple. So when a apple fruit is directly consumed, then it is final good. But when the same apple is used by agro-processing industry to manufacture, say, apple juice, then it is an intermediary use of apple. So then it will be considered as an intermediary good. Now, in national income accounting or GDP computation, we ignore intermediary use of different goods and services, because if you will be including in computation of GDP, there will be a problem of double counting. The same value of intermediary good will be counted once as intermediary good. Then when it is used as an input to produce final good, the final good will itself include the value of intermediary good within it. So the value of intermediary good will be counted twice. So to avoid this duplication in GDP computation, the statisticians exclude intermediary goods and services or intermediary use of different goods and services. They focus only on final value of goods and services or final goods or services. Okay, so how to do that, I'll be discussing with an example when I'll be discussing about GDP computation using product method. Now let me move to a simple example to explain how GDP is computed. Assume take a country, say Ecoland, which produces just two goods, good one and good two. And say in 2020, the quantity of good one produced is 100 units, and unit price of this good is say 8. Then value of good one in 2020 produced in Ecoland is 800. You can basically see from this arrow, okay, 100 multiplied by 8, I'm getting 800. That is the value of first good produced in Ecoland for 2020. Similarly, the second good, if total 25 units of good produced in 2020, and if unit price of good 2, there's a type error here, it is good 2 basically in the column 1 2 3 4 5, in the column 5 this is good 2, price of good 2 is 4 in 2020, then value of good 2 which is produced in 2020 in Ecoland is 100. So 800 plus 100. So value of GDP in Ecoland in 2020 is 900. Similarly, for 2021 and 2022, we can calculate the value of GDP as shown in this table. Okay. Now, I was discussing about the distinction between nominal GDP and real GDP. So when we compute GDP by multiplying the quantity of production of a particular good with its respective price in that particular year, we get nominal GDP. For simplicity, I have assumed that there is say one good produced in this country in 2020, the quantity of production was 1221, and say unit price is 10, then the value of GDP is 1221 multiplied by 10, so 12,210. So this is the nominal GDP. Now, what is the distinction between the nominal GDP and real GDP? if we multiply the quantity produced in a particular year by the price of the base year, okay, then we get real GDP. This is explained for 2021. In 2021, quantity of the good produced is 1228 and unit price is 11. So if I multiply unit price for 2021, which is 11, with the respective quantity, I get 13,508, which is the nominal GDP for Ecoland in 2021. On the contrary, if I multiply quantity produced for 2021, which is 1228, with unit price of 10, that is, if I'm using 2020 as the base year and unit price in that year was 10, so then I get the value of 12,280. You refer to the last column of 2021. So the GDP value in real terms is 12,280 in 2021, that we refer as real GDP, and nominal GDP in this year is 13,508. What is the distinction you observe? When we multiply the quantity produced in a particular year with the price of the same year, we get nominal GDP. On the other hand, when we multiply the quantity produced in a particular year with the base year price, we get real GDP. Now, why it is important to compute GDP in real terms rather than nominal terms? If we use nominal GDP over the years, it will not appropriately reflect the change in economic size or economic activities of a particular country. Economic size I'm counting in terms of quantity of production, amount of income generation, etc. So imagine when we are comparing GDP of say 2020 with 2021 in nominal GDP terms, then the change in nominal GDP reflects change in two things: change in quantity produced from 1221 to 1228. It also reflects the impact of change in price from 10 to 11. So nominal GDP over the years are not strictly comparable to assess change in production of goods and services, because nominal GDP changes also embody change in prices over the years. On the other hand, real GDP discounts for change in price. It is using price of the base year for computation of GDP. So comparability of real GDP over the years is appropriate when we want to compare change in size of the economy or change in production, income generation, etc. in an economy. Okay, so you can see these numbers which are given in the bracket are the annual growth rates. So if we compare nominal GDP, the annual growth rate in 2021 is 10.6%, which is written in blue within bracket. But in real GDP terms, the growth rate is 0.06. Okay, so that way it is 0.06 is a better way of comparing change in production of goods and services. Now, if you see for the year 2000, you compare production between 2022 and 2023. You see, actually there is a fall in production. The GDP, the production in 2022 was 1314. It is down to 1310 in 2023. But if you compare nominal GDP, it is showing there is an increase from 16,425 to 18,340. So this increase is because of rise in price between 2022-23 from 12.5 to 14. So when we take into account real GDP, okay, you see the real GDP in 2023 is less compared to that in 2022, which is appropriately reflecting the change in production. So that's how the real GDP growth witnessed a negative growth in 2022-23 compared to the positive growth of nominal GDP in 2023. Okay, so real GDP makes GDP across the years, sorry, over the years comparable. Now the next thing is how we can use GDP for comparing across the countries. Let us understand Indian GDP is measured in rupee, American GDP is measured in dollar, Chinese GDP is measured in yuan. Okay, so now certain number in rupee is not comparable with certain number in dollar. It is like you are comparing apple with oranges. So for appropriate comparability, GDP of different countries need to be converted into a common currency. Say, I'm giving an example here. Say US GDP, say let us talk about a situation where we are converting GDP of different countries into a common denominator like dollar, then how it makes comparability across countries in terms of their GDP. So US, in terms of dollar, it is their GDP is at 29.18 trillion. Indian GDP is 321.11 trillion in rupee terms. So in rupee terms, our GDP is much bigger as a number compared to the American GDP. Okay, so it doesn't mean that India is a bigger economy in terms of size compared to the USA, right? So for better comparability, as I said, we need to convert into a common currency. So if we are using rupee dollar exchange rate as 82.12 as an example, so then 321.11 trillion rupees can be converted into 3.91 trillion dollar. So what I did, 32111 trillion in rupee divided by 82.1253, which is exchange rate of rupee versus dollar, gives me 3.91 trillion dollar. So in terms of dollar, Indian GDP is now 3.91 trillion and US GDP is 29.18 trillion. So then it makes comparability, better comparison between India's GDP and the US GDP. Similarly, Chinese GDP in terms of yuan is say 134.81 by dividing 7.0360, which is the exchange rate of yuan per USD. Say we get Chinese GDP in terms of dollar as 19.16 trillion. So then it is comparable with Indian GDP of 3.91 trillion or American GDP of 29.18 trillion. So using that among these 5 countries in my hypothetical example, I can say American GDP is the highest, Chinese GDP is the second highest, Japanese GDP is the third highest, Indian GDP is the fourth highest, and the Singapore GDP is the lowest among the 5 in this hypothetical example. So this way we can use exchange rate to convert GDP in a domestic currency denominated value to a common currency denominated value like dollar, and then it makes GDP comparable across the countries. Now, as I said, GDP can be a proxy for total value of goods and services produced, which is also equal to aggregate income generated in a particular country for production of from the production of various goods and services, and which will be also equal to the total spending of different stakeholders, households, investors, government, the foreigners net. So that will basically total spending on goods and services produced in a particular country. So this equality I have already explained in the previous session on circular flow of income. So those of you interested may please go back and see that video to understand how these 3 are comparable or same in a particular country. So using this fact that total value of goods and services produced is equal to aggregate income is equal to aggregate spending, which is nothing but GDP, we have 3 different methods of computing GDP. So first method, product method, this basically adds value of various final goods and services produced in a particular country. The income method adds up different forms of income in the form of wages and salaries, profit, interest income, rent income generated during the production process. Basically, the factor reward which the producers give to various factors of production for their contribution to produce different goods and services. Okay, when we add up these four forms of factor income, that is wages and salaries plus profit plus rent income plus interest income, what we get is GDP in terms of income method, using income method. Similarly, GDP can be computed using expenditure method, where different expenditure of different stakeholders, like total expenditure of households, total income of firms producers, not income, spending, total spending of households, which is consumption spending, total spending of the producers, which roughly the investment spending, total spending of government expenditure, plus total spending of foreigners, net of our spending, domestic spending on foreign goods, that is net exports. If you add all these four types of expenditure, we'll get GDP under expenditure method, which I'm going to explain one after another. So first, let me talk about computing GDP using production approach or production method. So in production method, as I explained about the concept of GDP, this is sum of value of final goods and services produced in a particular country within a particular period. Now the problem is, it's very difficult to collect data on value of final goods and services. It is very difficult to, for a statistician, for a surveyor to collect the data on the spending for final use, for intermediary use, and then segregate. So an indirect method is used for that, which we call value added method. So in different stages of production, different producers add value to a particular product. I'll explain with one example. Assume in a particular country, three goods are produced. First good is a wheat grains. Wheat grains are produced by the farmers, and entire wheat grains are converted to wheat flour by the miller, and the entire amount of wheat flour is used by the baker to produce breads. And assume that all the households in this economy are consuming only bread produced by the baker. So this is the only final good. Bread is the only final good, and wheat grains and wheat flour are used only for intermediary purpose, basically for producing next stage of good. Say in this example, assume the farmer input cost for the farmer is zero. This is a simple example. If you are giving a realistic example where farmer is incurring some input cost, the calculation will become complicated, but the conclusion will be the same. So I have simplified the thing. I'm assuming that the farmer is not incurring any input cost, and it is producing wheat grains of say 100 kg, and the price of each kg of wheat grain is 50. Total value of wheat grain produced by the farmers in this country is say 5,000. Now, as I said, the entire amount of wheat grains are used for next stage of production as input. Say millers are purchasing this entire amount of 5,000 worth of wheat grains, and they are converting them into wheat flour of say 100 kg. 100 kg of wheat grain getting converted into 100 kg of wheat flour, and if each kg of wheat flour cost 60, then the value of wheat flour produced by the miller is 6,000. So here the value added by the miller is 1,000. Basically, I have calculated value added as its final output of the miller, which is 6,000, and its total input is 5,000. So 6,000 minus 5,000, I get 1,000 as value added by the miller. In the first stage, total value added by the farmer was 5,000. The same way, because I had assumed input cost as 0, so its value added is final value of 5,000 minus 0, so 5,000. Now let me come to the final stage of production, where the baker has purchased the entire amount of wheat flour produced by the miller, okay, So input cost for the baker is 6,000, and it is producing total packets of say 300 packets of bread, and if each packet cost 25 bucks, then the value of output of the miller is 25 into 300, so 7,500. So in this example, the value of final good is 7,500. Okay, you can see this is also equal to the sum of value added in three stages of production. In the first stage, production of wheat grains, the value added by the farmer is 5,000. In the second stage, the miller has added value of 1,000, and in the final stage, baker has added value of 1,500. Basically, baker's final output value is 7,500 minus input cost of 6,000. So value added is 1,500. So if I add value added by the farmer 5,000 plus that of miller 1,000 plus that of baker 1,500, then I get 7,500. So although it is difficult to calculate the value of final goods and services in reality, but indirectly we can calculate value added by different stakeholders, different producers in an indirect way by adding up the value added at each stage of production. So in India, if you are referring to the press release by the Ministry of Statistics and Program Implementation, then you will get press release on national accounts on GVA, gross value added. So this is one of the press release where the first quarter GDP for 2025-26 are given our current price. This is a nominal GVA. So across different sectors, primary sector, manufacturing sector or secondary sector, tertiary sector. So our statisticians compute value added at different stage of production, and then summing up we get GVA, gross value added at basic price. So if we say for 2023-24, this was 65 crore, 71 lakh 552 crore. So roughly it is 65.7 trillion of rupees. Okay, so this is the production method, or this value, these numbers are obtained by using production method or value added method. So this is, as you can see at the top, it is mentioned as current price. So this is a nominal GVA. So when in 2023 the quantity of production of different goods and services multiplied by the prices of those goods and services in 2023-24, we got nominal GVA of 2023-24. Similarly, by multiplying quantity produced of different final goods and services in 2024-25, multiplying by the prices of respective goods and services in 2024-25, we got these values, and the GVA in 2025-26 is around, we're talking about first quarter GVA. Okay, each one of them is for the first quarter. So that number is 71.9 trillion. Okay, so for different years we are reporting here, or the numbers which appear here corresponding to nominal GVA. This is basically counterpart of nominal GDP, and the nominal GDP values are correspondingly given in the last row in this table. Okay, now here similar numbers are given, but these are basically numbers referring to the real GVA or real GDP. You see at the top corner, so these GVA numbers in the title, this title is quarterly estimates of GVA at basic prices for Q1 of 2025-26 at 2011-12 prices. So 2011-12 is used as the base year. Okay, so here this GVA is at constant price. So using 2011-12 price, multiplying that with quantity produced in different years, we got the corresponding numbers. So this number 338.9 trillion, which is GVA of India for the first quarter of 2023-24. Okay, this is constant GVA. It's a counterpart of constant GDP. Okay, so correspondingly, constant GDP is given in the last row, 41.7. Okay, or this is real GDP. GDP are constant prices or real GDP. So here constant prices is price of 2011-12 year. Okay. Now let me move to the next. Here I'm basically giving the GDP value which is computed using expenditure method. So broadly, four types of expenditure are used for computation of GDP. The first one is private final consumption expenditure. This is basically broadly household consumption spending. Okay, and the second one is government government final consumption expenditure. This is like government spending. And the third one and fourth one, if I combine gross fixed capital formation plus change in stock, 3 plus 4 is total investment spending. Okay. And then I think I have to add 3, 4, 5. So these three combined will give what is total investment spending. And then if I take 6 minus 7, that is exports minus 7, that gives us net exports. So this way, these are four broad components of expenditure of aggregate expenditure on different goods and services produced in India. So for example, total consumption spending, household consumption spending on different goods and services produced in India for the first quarter of 2025-26 is 41.9 trillion, the first number under 2023-24. Total government spending is 7.6 trillion. Total investment, if I add 22 plus 1 plus 0.4, so roughly 24 trillion is total investment spending on goods and services produced in India. And finally, 15 minus 16, so it is almost 15 minus 16.8. So nearly say 1.5 trillion, there is a deficit. Net exports is negative for us because we import more compared to export. So if we add these four components, total household consumption spending plus total government spending plus total investment spending and plus total net exports will give us total spending of different stakeholders on goods and services produced in India. So this gives GDP measured in terms of GDP is measured using expenditure method. In India, we don't compute GDP using income method. We only follow two methods, production method and expenditure method. And those countries where GDP is computed using income method, what they do, they aggregate different forms of income, factor income, which is generated in the production process, like wages and salaries plus profit plus interest income plus rent income, which is basically generated through production of different goods and services. If we add up, then one can get GDP as per income method. And these three methods with adjustment for discrepancies should give the same number of GDP. As we saw in the earlier table, the GDP which is derived from GVA and GDP which is derived from expenditure approach are same for India. Okay. Now, before we conclude on the concept and measurement of GDP, let us understand computation of GDP is a very, very challenging job. There are many deficiencies, many limitations in computation of GDP. Obviously, there are crores of households in this country, and there are a large number of economic activities, practically very difficult to count, and then value added in each of these activities or spending by each units of household farms, etc. is very complicated. Okay, so broadly, the sampling method is used for calculation of GDP, whether using value-added method or using expenditure method. So naturally, there are many limitations of limitations and deficiencies in computation of GDP. So the GDP numbers which are produced are basically the best approximations reflecting total production of goods and services or total spending in Indian economy. Now, conceptually, there are certain deficiencies in consumption or in computation of GDP or measurement of GDP. So, first of all, when we're talking about various economic activities, a particular economic activity for which a transaction is recorded can only be counted as part of GDP. If there are certain activities, economic activities, which are more of voluntary and which doesn't involve a transaction, a payment for the service, okay, or a payment for the good and service, then obviously it will not counted as part of GDP. To that extent, the GDP estimation will be underestimation. It is underestimation. Say for example, if I'm helping my kids in their studies at home, okay, so this is a service which I'm giving to my kids, but it is not counted as nobody pays me for it. On the other hand, if I engage a tutor to teach my kids and I'm making a payment, then obviously the salary, which remuneration which I'm giving to the tutor will be counted as part of GDP. Similarly, in the homemaker in Indian households, the amount of services which they're giving in terms of cooking food, taking care of the family, for that there is no payment, so it doesn't get reflected in India's GDP. On the other hand, when we are employing a maid for cooking food or helping in household things, then the wages paid to her uh, get reflected as part of Indian GDP. So to the extent there are home production which are not reported, it is a home production and it doesn't get reflected in computation of GDP, and that's a limitation in GDP computation. Then there could be certain transactions where there is a payment for the transaction, but then it is not reported. Say for example, black economy. Okay. Uh, say the consumption or production of drugs, transaction in drugs. So the sale or consumption of drug is prohibited, so nobody reports it. Okay, but production and consumption of drug takes place. So that way, the economic activity in terms of production or consumption of drug, which has happened, but it doesn't get counted while computing GDP. Then certain activity, as I said, if I'm engaging a tutor for helping my kids in their studies, if this individual doesn't report her remuneration or wages to the tax authorities, right? Then it is not an illegal activity, but it is a gray market where the transaction is not reported. Okay, so to that extent, if it is not reported, it's a gray market transaction, then it doesn't get reflected in computation of GDP. Then the third limitation in GDP computation is it doesn't take into account the sustainability issues. Say in production of goods and services, particularly in industrial production, fossil fuel is used, coals are used, mineral ores are used. So to that extent, there is depletion of natural resources when production of different goods and services taking place. Now, these depletion of resources are not adjusted when we are computing GDP, right? So to that extent, on these three broad accounts, home production, underground economy, and the negative externalities involved in the production or process of different goods and services, which are not getting reflected in actual real GDP computation. To that extent, computation of GDP suffers from some deficiencies. Okay, so and on top of that, obviously there are deficiencies in terms of data collection, reporting, computation, and the errors in the sampling method where the samples are not adequately representing the entire population, and the sort of underreporting or overestimation due to the blowing up factor, those also get into the limitations or deficiencies in computation of GDP. So I hope this session was useful. But given the paucity of time, I only covered the very essential issues involved in computation of GDP. And if you have any doubts or you require more information, if you write back to me, I'll try to, you know, come up with additional information to help you out. Thank you for watching my video.